If you live in a city like LA, New York, or DC, where home prices are just super high and you can't afford them, but you still want to invest in real estate, I'm going to show you a step-by-step, data-driven process where you can find the perfect city for you to invest in that has homes cheap enough for you to buy. If you follow this process all the way to the end, you'll be confident about where you're picking and you'll find a perfect city for you based on your preferences. This way you can start making passive income and become financially free sooner. For those of you that don't know me, I started off my investing career living in New York with only $5K in my bank account. I was working full-time as a software engineer. I always wanted to invest in real estate though, because everyone that I spoke to that was rich had some form of real estate. But what the hell was I gonna do with only $5K in my bank account? I couldn't even afford a cardboard box on the side of the street in New York. So I told myself that I'd keep saving and waiting. 2 years go by and I'm nearly in the same position. I live in New York, but now I have $30K to invest and I'm still a software engineer. Then one day, everything changed. In July of 2019, I got an email from my landlord at the time. He said he was raising our rent by 15%. I was furious. I was already paying $2K a month to live in a box and had no space to do anything. I never complained, never had parties, never asked for anything fixed. I was just so confused why he decided to charge us more. It was at that moment that I said to myself, no matter what, I'm gonna figure out what it takes to be on the owner side of things, not on the renter side of things. The problem was I was still faced with this problem. Home prices were way too high in Manhattan. And there's no way that the $30K that I had would have bought me anything. Not only that, but like even if I bought an apartment, it wouldn't cash flow or make me a profit because the home prices were too high. So again, I was defeated, but I was determined not to give up. I needed to find a way to get into a rental property. So then I started looking at the map. Everywhere close to New York City, I was looking. I was hoping that maybe I could take a train to some of these areas to go look at properties. Problem was, I didn't know any of these places, so I had to start doing research. So I read blog posts about them, went to meetups, and I talked to other investors online and in person, just so I could get an idea about their experience in investing there. They all gave me different opinions. One person said it was great for them to invest there. Another person said they had a terrible time. So I just kept having mixed, conflicted ideas of what was the right thing to do and where the best place to invest was. I even started doing this for cities across the country that I thought were decent. Places like Las Vegas and Atlanta, where I heard people were moving to and home prices were going up. Only problem was I had never been to these places before, and I knew nothing about them. So I was scared of putting my money into something that I knew nothing about at all. But again, with every post I read about those cities too, I had mixed reviews. Some said it was great, others brought up a bunch of problems, so I never had a clear answer on what was good and where was the best place for me to put my money. I was overwhelmed and I had no clue who I could believe. All I wanted to do was just to not make a mistake. I honestly was scared of putting my entire life savings into a property and then have it be in a bad area just to find out that afterwards and I wouldn't be able to do anything or I'd lose hundreds of thousands of dollars. But I knew there had to be a way. There must be a way. There had to be a way that all these landlords were buying properties and they knew exactly what they were doing, because there's no way they would take chances like this. What I did was I pulled out all the investing books that I had and I told myself that I was going to dissect every little page that they had anything to do with location research, and I was going to figure out how to come up with a formula. If you want a list of the books that I was reading at the time, I'm going to leave a link below to Amazon list of all the books you need to start with. I started jotting down all the factors that they were talking about, like crime and unemployment, things like population growth, price to rent ratio, home prices, schooling, that kind of thing, property taxes, and landlord friendliness. And don't worry, we're going to go into all of these in just a second. What I wanted to do was find data points for all of these factors, because numbers don't lie. Numbers don't have an opinion on what happened to them like all these other investors that I was reading online about and talking to in person about. So I went all over the internet to try to find different data points in order for me to be able to come up with a strategy on how to actually do this. This way it'd be really easy and clear what city would be best for me to invest in. So what I did was I took all those cities that I was thinking about before and I put it on a list and I looked up all the factors for each of the cities. I then totaled them up based on how good or bad the factors were and gave them an overall score. I compared them from city to city, and in the end I ended up selecting Ewing, New Jersey. That's where I rented to go to college. Even though it was about 2.5 hours away from New York City, it was still commutable on the weekend. I knew the area and had a great price to rent ratio, so it was a good cash flowing area for me to get started in. Honestly, without the data-driven process, I honestly think I still would be living in New York City, not investing, and having no clue where to start. So let's not wait any longer. Let me take you through the entire process. This way you can learn how to do this yourself and figure out how to get started investing sooner in the right city. I'm gonna go through each factor, tell you what it is, why it's important, and then we'll talk about how to actually go find it on the internet. Here we go. First up is crime rate. All crime rate is it just a number that represents how much crime an area has. You're gonna want to invest in safer areas. Now, the lower the crime rate is, meaning the safer the area is, the higher the home price will be, the higher the rents will be, and the lower your vacancy, because people are actually going to want to live there and stay there long term. And you'll have a higher demand for people to want to live there, which will be great because you'll reduce your vacancy again. On the other hand, if the crime is higher, meaning the area is less safe, home prices are going to drop because less people are going to want to live there. Because less people are going to want to live there, you're going to have less people trying to rent it, reducing your demand, decreasing your rent, and increasing your vacancy. Not only that, but you'll probably have a lot of issues with people breaking into your property. You're dealing with people that deal in with a lot of break-in and drug activity, and you want to avoid that. And if people are living in that situation, they likely don't want to be there for long. So you're going to want to get out of that as soon as possible. So what you really want is an area that's safer, and let's hop over to the computer to find that for you. All right, so the first thing you're going to want to do is pull up a spreadsheet like this. You're going to have the cities and all the factors down here. So first thing is, let's go to crime rate. So we're gonna search for citydata.com, and we're gonna go to, let's do Memphis, Tennessee. We're gonna search Memphis, Tennessee. Okay, and then the quick way you could find it is by searching crime, and then you'll get a table set up over here, and you copy this last column over here, 819.16. And so you go over here and you add that to the Memphis, Tennessee column. All right, the second factor you're going to want to be looking for is the unemployment rate. All this number does is it tells you how many people in the area don't have jobs. The lower this number, the better. If it's lower, that means you're going to get your rent paid because people who have jobs can actually pay you rent. Also, home prices will go up because that means more people will have jobs. If more people have jobs, then they can afford a mortgage. If they can afford a mortgage, then guess what? Your home price can go up because that means there's a higher buyer demand. Now, if there's a higher unemployment rate, the opposite will happen. You're gonna have a bunch of people that don't have jobs, so they can't pay you rent, right? You don't want that. Also, you're gonna have home prices not go up over time because you're not gonna have people that are actually gonna buy the houses, and that's part of the problem. So here's how you get the unemployment rate. Do this again by going to citydata.com, and you look for Memphis, Tennessee, if that's the example we're using, whatever city you're looking for. Then you can search unemployment rate. Okay, you get 8.6%. This is the percent from November 2020. You're going to copy that and you're going to paste that here. The next factor we're going to be looking into is population growth. This is a number that represents how many people are moving to or away from an area. We obviously want this number to be higher because if people are moving to an area, the demand for housing is going to go up. The rent prices are going to go up because you're going to have more people that are wanting to live there. And then vacancy is going to go down because you have more people that are there, so the demand goes up. This is what's happening right now in Austin where I live. So many people are moving there that the home price is skyrocketing, the rent prices are skyrocketing, and the vacancies are going down all across the board. On the other hand, if the population growth is low or even negative, meaning people are moving away from an area, the worst is going to happen. The home prices are going to go down because people aren't there to buy it. Rent prices are going to go down because people aren't there to live there. And vacancy is going to go up because, again, people aren't there to live there. And this would be actually pretty concerning for me. If I saw this on one of my data points, I would try to look at it and see what could be causing this thing. Because if it's a serious underlying issue with the town, then that might be a problem for you very long term. And if you're buying for rentals, you don't want to invest in areas where the population growth is low. All right, here's how you find out population growth. USA.com/rank. And so you can look up the city, Memphis, Tennessee, and you'll see that the population growth was 1.02% in the last 20 years. So you copy that and you put that here. Next up, we want to find home prices. This is a really important one. We're going to be looking for a median home price in the area because what that does is it allows us to see about, on average, how much homes cost there. And the important part to remember about this is when you're buying a house for a rental property, you're looking for it to cash flow. The formula for calculating cash flow is taking the income and subtracting the expenses. The income's the rent, and the expenses are a bunch of things. One of the expenses is your mortgage. If the home you're looking for is really expensive, then you're gonna have a really high mortgage. The mortgage is usually the highest expense you'll have on a rental property. If the home price is high, you're gonna have a higher mortgage, which means higher expenses, which means lower profit. which is not what we want. Not only that, but finding a house that you can actually afford is crucial here, because if you don't have the money for the down payment, you can't even afford the home price. So what's the point? You can't get started. And the higher the home price, it'll be harder for you to scale over time. So you want to make sure that you're finding lower home prices. And let's go onto the computer to find it now. You go to Zillow.com/research/data. You're going to have ZHVI, all homes, SFR, condo/co-op, time series, smoothed, seasonally adjusted, and then you click geography, you go to city, and then you click download. All right. I already have a copy downloaded, but give it a second and it will open up this one. And on this sheet, you will find every city's home price with median home prices month by month by month. Okay. There you go. And if we wanted to do, we could highlight this column C. It'll make it really easy for us to search Memphis. You search Memphis. Okay, you get the city and you go all the way to the right. 137,127 is the median home price in the last year. So you would write that here. Median home price, boom, 137,127. Cool. The next thing we're going to need is rent prices. Going back to the example before, the higher the rent price, the higher the income. The more income you make, the more profit you'll make as an investor. So here's what you need to do to find the rental income. You're going to use this URL, rentcafe.com/average rent market trends US/TX. Okay, so you want to put the state there, Tennessee, TN for Tennessee, and then we're going to do Memphis. And it'll give us the average rent for Memphis. Boom, $984. You copy this and you put this into your spreadsheet here. Okay, so now that you have the home price and the rental income, you need to figure out the price to rent ratio. The formula for the price to rent ratio is just the median home price divided by the median annual rent. So if this number is higher, what that means is that we have a really high home price and really low rents. And that's bad, because that means our cash flow will be lower and our ability to scale and get more properties will be lower. On the other hand, if the price to rent ratio is lower, then our cash flow will go up and our scalability, our ability to buy properties and get money faster is going to go up. This is the most important, I can't stress this enough, the most important factor when it comes to rental property investing, because most of our income comes from rent and most of our expenses come from the home price. So if we don't, from the mortgage, sorry, and the home price affects the mortgage. So if we don't have a low price to rent ratio, you can't invest anywhere. You'll automatically want to calculate the price to rent ratio. That is the median home price divided by the annual average rent. So if you see, you multiply this number by 12 and then divide that into this number on here. The formula is on the sheet already. And so that gives us 11.61. The closer the number, the better. All right, only two more, I promise. The next up is property taxes. This is how much the town charges you for having the land in the house. What we're looking for is lower property taxes on average. Property taxes are really important because if you look at the formula again, income minus expenses, and just like how a mortgage is one of our expenses, property taxes are another expense. And if property taxes are higher, it will hurt our chances of making cash flow. If they're lower, it'll increase our chances because our expenses will be lower. Our income will therefore make more in the end and we'll have higher profit. So let's find the property taxes now. smartasset.com/taxes/property taxes. You're going to type in where you're at or where you're looking to invest. Memphis, Tennessee. You search 1.42% and you write that there. The last factor we need is if a state is landlord friendly or not. See, each state and city's got their own laws, their own things that they do when it comes to tenant and landlord relationship. The laws either protect the tenant more or they protect the landlord more. There's laws to do with how quickly you can evict someone or how much money you can take in a security deposit. You want to invest in landlord friendly states because landlord friendly states protect you as a landlord. They reduce your risk. For example, some of my properties are in New Jersey and one tenant specifically hasn't paid rent from May to January, and because she lives in New Jersey in the property, I couldn't get rid of her from my property because of the moratorium. So I lost out on $5,000 in rent. I had to pay the mortgage, the tax, insurance, and everything. So let me show you how to find out if a state is landlord friendly or not. Okay, you want to use this URL here in order to find it. And you look at Tennessee. Tennessee is 55, so you write down that score. All right, so now that you have all the data, what do? Let's go over to the spreadsheet and come up with rankings for each city based on each factor and then give them an overall score. What you're gonna do is you're gonna factor each column, I'm gonna sort this sheet from 1 to 8, okay? Because we have 8 cities. And I'm gonna give a score for each one, lowest being the best. So 1 is the best crime rate. Okay. Then I'm going to rank these by that to give them a score. Then I'm going to go to unemployment rate, and I'm going to do the same thing here. You want a low unemployment rate, so I do the score. Population growth, you can do the same thing, except you want highest to lowest, because highest means better population growth. Same thing for home price, except you want to do lowest to highest, okay? And you rank them that way. Then for rent prices, you want to do highest to lowest, because highest rents are better. Price to rent ratio, you want lowest to highest, 11.61. Price to rent ratio, you want to do something that is that's the price to rent ratio score. Property taxes, you want something that is lowest to highest, so you do A to Z. And then landlord friendliness, you want something lowest to highest. You got 27.5 to 72.5. Then you're going to add up all of these scores and give an overall score for all of the cities, and you're going to sort them. All right. So you see the city with a 27 is the best city technically you should invest in, and that is Boise, Idaho. That's only if you have that kind of money, of 519 to invest. Now maybe Boulder, Colorado is another one you want to take a look at, or Jacksonville, Florida, based on home prices and stuff. That's what you have to do. You have to look at it from your perspective on what is best for you, and that's a data-driven approach on how to invest in real estate. Once you're done, you want to end up picking a city that has the best ranking possible, lowest overall score. Then you can take this and then go call up a bank and get a pre-approval letter so you can start looking at properties and go out and buy one. And if you're investing out of state, somewhere far away from where you are, totally okay if you want to end up spending some time in that area. So take a weekend to go visit and go check it out. If you found this helpful, I ask that you share this with a friend. I've been making videos on YouTube for 5 years and I only have 2,000 subscribers. If all 2,000 of you took this second to share it with one friend, I'd have 4,000. All jokes aside, I just want to help as many people as possible get their first investment property, because that first one is the hardest one, and then after that you'll be on your way to financial freedom. Now, if you're lazy like me and you don't want to do any of this process, even though I outlined it step by step, I'll do the process for you. I'll leave a link in the description for you to fill out a form so I can do the process for you. It costs $250. If you want to see how much I'm making from all of my rental properties and get a complete breakdown, click the video on screen to watch it over there, and I'll see you in that one. Peace.